Good Lord, please stop giving the IRS more money than you need to. Watch on for a client I'm working with right now on some charitable strategies that hopefully you can steal some of the ideas from for your own situation. Hey everyone, I am Andrew. I'm the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. And what I do is I take the learnings from the thousands of iterations I've had with ultra high net worth investors and I give them to you so that you can apply them to your own life. Today I want to talk about charitable giving and how, depending on how charitable you are, you can really lower your tax bill, especially if you are strategic in how you approach it. So for example, I have a client that I just met with within the last week who right now is making about $1.5 million a year. Most to all of it is W-2 ordinary income. And he is about to get the boot from this tax legislation change because the OBBBA, the OBBBA, it's so hard to say that. The new tax legislation that came into effect this summer, starting in 2026, has a line item that I'm sure some of you are aware of, but for those of you that aren't, there is now a floor of a half of 1% of your adjusted gross income whenever you're itemizing does not count towards your itemized deductions. And so for this client who's making $1.5 million a year and has been philanthropic before, the first $7,500 that he gives in any given year no longer counts towards his deductions. Now, you give money away towards some philanthropic cause because you think it's going to put good into the world. You don't do it only because you think you're going to get money back for it, right? If you wanted to just personally benefit from it, you'd keep the money and you just pay the tax. But for many people, there's both the benefit of helping a charity that they care about and also getting some type of tax break for it. And with this new piece of the legislation, for somebody like him who is giving about $10,000 a year to charity, now he's getting none of this second or the tertiary benefit. And so what we're doing, what I'm going to call a multi-pronged approach. So he typically gives around $10,000 a year, but he does think it's going to go up because his income has jumped recently. And so we decided we're going to set up a donor advised fund in the year of 2025, and we're going to contribute $100,000 to it. Now, the question is, how do you fund that? There are AGI limits to donor advised fund contributions, which with how high his income is, doesn't really apply, but it's 60% of AGI if it's a cash donation, 30% if it's a long-term capital gain. So for him, what we're doing is we are donating securities that have the highest unrealized gain. So for example, let's say he owns SPY and he has a $40,000 basis. He paid $40,000 for it and there's $60,000 of gain. He's transferring all 100,000 of that position, okay, by identifying the position with the lowest basis, or said inversely, the highest gain. That's long term. And he's putting that in the donor advised fund. Now he has cash over here that he could have donated, but instead what we're going to do is we're going to take that cash, we're going to put it right back into his investment account, and we're going to buy SPY. And so now he has a basis of $100,000. So he gets a twofold benefit. He is getting the deduction from the donor advised fund where we're bringing forward future years of giving, and he's increasing the basis within his own investment portfolio for future distributions. In addition to that, there's a tax credit that a local charity he likes to support has with the state he's in. You can give up to $20,000. You get a 50% tax credit for your state tax liability in the state he lives in, and you get a deduction federally for the full amount of the amount you give. So he's giving $20,000 this year. He's going to get a $10,000 state income tax credit, and he's going to have $120,000 of deductions against his federal return. And when you add all of that together, getting a $10,000 benefit from the state income tax credit, and then roughly 40 cents on the dollar of benefit on the deduction side, because he's itemizing, he's bringing forward all of those future years of giving. He's getting roughly $50,000 of tax savings this year for money that he would be giving away regardless. And that's the key. It's money that he'd be giving away regardless. He's just being strategic in the year that he gives it. Now, he has a hyper-specific situation where his income is very high, and so that 0.5% AGI floor for giving that starts next year is a really big deal. If you have a depressed income because you just retired or you just sold your business and now your AGI is $100,000 next year, well, $500 is really not that big of a deal, right? You're more likely to be running up against the 30 and the 60% AGI limits on a donor advised fund contribution. My point is, there are multiple angles and multiple situations, and they truly are nuanced. And depending on the makeup of your W-2 income, the makeup of your business and K-1 income, or the makeup of your capital gains income, many different strategies can work. But in his situation, I thought it was a nice example of how the new tax legislation can impact somebody who is charitable. And it's a way that we're trying to make sure that the money still gets in the hand of charities, but also he gets the tax benefit by bunching giving, opening the donor advised fund, and still giving to the local charity that he supports. Hopefully that is helpful. If I've missed something, go to leverwealthmanagement.com/ask. Ask me any question, and I promise I personally will respond to you. And until next time, thanks everyone. See y'all.